This week on Case Studies with the BizDoc, it's Robinhood, a suggestion I took from you. Where did they come from? Where are they going? What's up with that $5 billion valuation and the story this week that they're preparing to go public? All of that and more. Robinhood, the financial services company that's in the app, on your phone, in the palm of your hand. Let's do three things. First, talk a little bit about the history, the money they raised, and how they got to that $5 billion valuation that they're talking about today. Second, where are they going? There's a big news report out that they're looking for a professional CFO. Why? Because they're going public and they want to file an IPO. And third, I'm going to talk about what do I think is really the essence of Robinhood. How did they jump into a financial services sector that's got Schwab and E-Trade and all these big companies already there that are available with systems to help you trade stocks? How did they jump in and what made it so special? Let's start with the history. Once upon a time, back in late 2013, these two guys, Baiju Bhatt and Vladimir Tenev, are working in financial services. They leave to go create Robinhood. They had a vision to do some very special things and to make it easier for you and me to trade. Specifically, to trade for free, but then we'll pay fees for other things like interest on money we borrow, because in a margin account, some of the money is yours and some of the money you borrow. The money you borrow, you pay interest, just like a credit card or a car loan or any other kind of loan. That's where they were going to make their money, but make it really easy to trade. The reason they did that is because they had talked about in a lot of interviews that they say, look, if some guy's dropping $200,000 to buy a big chunk of Facebook, that guy doesn't care whether it's a $12.95 trade or a $7.95 trade. But guess what? Most average investors don't make trades that big. So that's $7.95 and $12.95, is real money on a $100 or $200 or $300 trade. And why should people be paying that? We'll make it for free and we'll charge them fees for certain things. And they envision subscriptions downstream, and that's where they would make the money. Meanwhile, all the trades would go on free. That was the essence of it. In a way, it was kind of a blue ocean. And in the blue ocean framework, you eliminate things, raise things, reduce things, create things, and that gives you a blue ocean, doing something different. Now, this I call a light blue ocean for reasons I'm going to get into at the very end of the case study. But what did they do initially? They eliminated fees. What did they raise? They raised accessibility. There was already access on the internet for a decade or more for getting to your stock trading, and it was getting easier and easier. And there were trades you could make right on your phone connected to your master trading account. They made it even easier and made the phone app even slicker. Then they reduced friction. They allowed you to deposit money very easily and have that money be immediately available to make trades today. In doing all this, they created what I call a light blue ocean back at the end of 13. It was December to be exact. At the beginning of 14, they come out and very quickly they claim to have 100,000 people on a waiting list to get the app. In other words, to be part of the beta or the launch. There was two that were very close together and it was basically rolling right out to the market. Later that year, they claimed they had 500,000 people on the waiting list, and they introduced the iOS version of the app and they were off and running. Let's keep following the subscriber line that we're talking about here, and then I'm going to get to the investment in just a second. They go and they're at 500,000 users, but by the end of 16, with the Android version of it out and the iOS version. Now they've got both versions out, so anyone in the United States, regardless of what phone you have, can get access to Robinhood. They reached 1 million subscribers before the end of 17, 1.5 million shortly at the beginning of 17, 2 million in the middle of 17, and today they say they're at 3 million or more and going to the moon. Suffices to say, they're not a public company yet, they're a private company, and these are numbers they're announcing. Nonetheless, I believe them, and I think that they're really off and running. The buzz that you see on the internet, the number of people using it, number of people talking about it, leads me to believe that I don't think this is a startup getting fluffy with their numbers. I believe these are the numbers that are there. Now let's step back and take a look at how they raised the capital. Well, they started here with a $3 million round. It was basically their seed money from Google, Andreessen Horowitz, and Index. And they raised that right around the end of 14. So they had been showing this to people, and people thought they were onto something compelling and made that early investment. Then here, when it launches, they raised $13 million that they announced in 2014, and I call this the celebrity round because there were some very interesting people that were investing at this point. First of all, Snoop. Yes, as in Snoop Dogg investing in a startup that's trading in stocks. You know, there's a million places where cannabis is very legal, and maybe you would think Snoop would be in that sector of the economy. Not that he has any expertise in that area, but instead he's actually out here investing in a stock trading company. And Snoop is joined by Jared Leto. And Jared Leto's lead singer, what's that, 30 Seconds to Mars. 30 Seconds to Mars. Thank you very much. Camera people and producers are useful. Along with DraftKings, their chief strategy officer, or one of their people over at DraftKings, back when DraftKings had money. He invests as well. And then Aaron Levy, who is a guy over at Box. Another one is there were celebrities and a lot of people that were connected in here that were in this round of 13 with the grand launch, with all this buzz about 500,000 people on a waiting list. Then, halfway through 15 and 16, $50 million. In 2017, big money. Now we're talking 9 digits. $110 million is raised, led by DST Global and NEA, and with participation from a fund that is led by Josh Kushner. And Josh Kushner is the brother of a guy who is the son-in-law of a guy who lives in the United States at 1600 Pennsylvania Avenue and likes to tweet. At that point, they also announced that they had crossed $30 billion in total trades through the life of the platform. That is really impressive. You take a look at that, $30 billion in total trade value, and you just launched this thing basically April of 2014. That is huge. Along with that round, they also announced that they had a $1.2 billion valuation. In other words, in just 3 years, they had entered the Unicorn Club. And we all remember what a unicorn is. It's a startup that's reached over $1 billion in valuation. Well, as you can imagine, and you take a look at what they were saying about subscribers and what they're raising here, this thing is on Elon Musk's rocket to the moon. Meanwhile, Elon Musk is smoking dope with Joe Rogan, and he's on the moon. We have a massive round that happens in the beginning of 2018. $363 million venture round at a $5.2 billion valuation. Now, wait a minute. Let's break that down a little bit. $5.2 billion valuation after a $1.2 billion valuation barely a year prior. Man, you know there's a word for that, and that is damn. They're not just in the Unicorn Club, they're in the club, and now they're back in the VIP partying with a $5.2 billion valuation. Not to be content with that, they're adding to the platform investing. They announced right after this round that now you could actually trade crypto on it, starting with 4 states and then getting to 19 states. Because here in the USA, different states feel different kinds of regulations are necessary when it comes to trading crypto. That is followed by, right about now, when we're in the third quarter of 2018, at the time we do this case study, they announce, hey, we're going to have an IPO. Well, you can say you're going to do an IPO, but you can't say too much else about it because there's laws and a thing called the quiet period and things. But you can say, I believe we're on a path to go public. At some point in time, they will file an S-1. An S-1 is available at sec.gov, and anybody on Earth can take a look at it and read the intricacies into the model. Find out whether these subscriber numbers are really correct. Find out what other things they're thinking about. How do they view competition? All of it by law has to be contained in the S-1 and is one of the most magnificent documents you can read on any company because it's a case study on that company that they have to present to the market. And if they shade the truth in it, there's a word for executives that shade the truth in an S-1, and it's inmates. So nonetheless, they also say help wanted, they're looking for a CFO. And if they're really looking for a great CFO, they should go look in Manhattan Beach, California and find a guy named Michael Marchetti. There's a CFO for you. Anyway, I'd like to step into part 3. And what part 3 is, now that we have the history and we see how they raise money, let's talk a little bit about this. Because a lot of you that gave me suggestions to do this case study were asking, what on earth is up with Robinhood? E-Trade and Schwab, and Ameritrade will let you get an app on your phone and you can do things on that. What is so special about frickin' Robinhood that everybody's going crazy over this thing? These guys had expertise. Bat and Tenev, working in the industry, had a vision for this. And when they bring this out, one of the things they think about is, hey, we're experts. We can do this even better. We're going to provide more services. We're going to do these things. Now you see why I call it a light blue ocean, because it's not a full blue ocean. It's close, it's really dramatic, but why wouldn't I call it a full blue ocean? Well, in addition to more services that you can ask your development team and your business development people to go out and get the contracts in place and build more services such as crypto, there's an issue here, and it is ain't nothing hard to copy by incumbents. And I think you understand why I got that little arrow there for incumbent. Now, why wouldn't JP Morgan and Merrill Lynch do that? Well, first, they've got wealth management teams that are charging people that put their money at Merrill Lynch fees every time they trade. Most of that stuff would be counter to them suddenly offering Merrill Lynch Lite, where you don't pay any fees. So there's some built-in issues there that they couldn't copy it exactly. But do they have the technology? Do they have the clearinghouses? Do they have the ability to say that they could do it like this? Do they have the ability basically to put the same product out and say, hey, if you have less than $100,000 in a trading account, you can trade with Merrill Lynch Lite and get all these benefits here, but pay interest on your margin dollars that you borrow? Well, sure they could. And that's why I say there's a real issue here in that the incumbents, if this really takes off, they could make a big step and copy this rather quickly. Also, there's security and regulations and a little caricature of Elizabeth Warren. I know she's supposed to look like American Indian, but right now I think she looks like a Halloween witch. Plus, we're almost in the fall, so I'm just going to go with that. Regulators can come out and put additional regulations in place that could stop this. And who might be lobbying for those regulations? Oh, Merrill Lynch, JP Morgan, Goldman Sachs. Might they be lobbying so that a upstart might face regulations and have a tougher row? You bet they would. The same way Amazon lobbies in Washington for things that favors it. And we've already seen Google lobbies in Washington for the things that would favor them. That's the game. The incumbents are going to draw barriers to entry using their might and their political force. So what do I think? I think Robinhood's a great product. I think it's really innovative. I use it. And I think what they've done with some of their pricing on the loans and the interest you pay is very novel and innovative. You can get a gold subscription and pay like $6 or $12 a month, and it controls the interest or the amount that you pay or the amount of money you can borrow. Like $200 a month, you could borrow up to $50,000 or something. It's set up that way so that these fee structures, something's got to pay for the service, are in place, but they're commensurate with what you have, but the individual trades are free. So that's what I think about Robinhood, but what do you think? Leave some comments down below and tell me what you think about big companies going to squash them, or some of those big financial companies, maybe one of them comes up and buy them. Or will they have a great life as a company public on the stock market after a successful IPO? Interested to know what you think. Also interested to know what companies you want to see me cover up on this board on case studies in the future, because Robinhood was one of your suggestions, and I appreciate it. Until next time, please subscribe to Valuetainment, the best channel on the internet for entrepreneurial content. And remember, when we get to 1 million subscribers, which is right around the corner, the first annual Valuetainment Entrepreneur Conference will be announced, led by Patrick Bet-David, and featuring people such as yours truly, the BizDoc, and other leaders to make you better, your company better, and the people you touch better still. Until then, I'm Tom Ellsworth, the BizDoc, and I hope I left you better than I found you.